Japan, a country known for its innovation, technology, and once seen as an economic powerhouse. But beneath this surface lies a ticking time bomb, its currency crisis.
To date, it's lost more than 21% against the greenback, and it's expected to weaken further.
Japan's central bank, the Bank of Japan, has taken monetary policy to the extreme over the past few decades, pushing debt levels beyond imagination. And while similar policies have been coordinated globally by the European Central Bank, Fed, and Bank of England, we're entering a period where political consensus is fraying. But here's the kicker. This impending currency crisis could actually ignite a violent repricing in Japanese equity markets. You see, while the yen is crumbling, Japanese equities are some of the cheapest in the world. Stick around, because today we're diving deep into why Japan's currency crisis is underpriced and how investors could profit massively from the coming storm. This video is produced by the team at Capitalist Exploits. Headed by professional asset managers Chris McIntosh and Brad McFadden, the team hunts for deep value assets that are surprisingly contrarian despite strong fundamental cases for potential future appreciation. If you're looking to gain access and insight as to the personal investments of active hedge fund managers and in-depth reasoning as to why they've invested in the assets they're sharing, check the links in the description below. You'll get access to advice on how to allocate, organize, and think about your portfolio, while joining a growing community of people thinking outside of the box. Enjoy monthly updates, open Q&As, regular newsletters, a community forum, organized portfolios, investing education videos, and more with the Capitalist Exploits Insider subscription. If you're not ready to fully take the leap, we also offer the Capitalist Exploits Insider newsletter series for $1 for the first 30 days and $35 a month thereafter. Do note, our investing strategy and philosophy can deviate a lot from the mainstream. We offer a money-back guarantee regardless, but make sure you're on board with our investing philosophy and global outlook before deciding to join us. Let's start by addressing the root cause of the yen's collapse: Japan's runaway debt and unconventional monetary policies. Japan's debt to GDP ratio now sits at over 260%, one of the highest in the world, putting immense pressure on the Bank of Japan. The problem? This debt load is so enormous that the central bank has found itself in a trap. If it tries to raise interest rates to fight inflation, the cost of servicing this debt would bankrupt the government. On the other hand, by keeping rates low, they're driving the yen's value into the ground, causing inflation to rise further. A central part of Japan's monetary strategy has been yield curve control. Essentially, the Bank of Japan caps the yield on 10-year government bonds to keep borrowing costs low, but this policy is backfiring. By keeping interest rates artificially low, Japan has made the yen incredibly unattractive to global investors. Capital is flowing out of Japan and the yen is steadily weakening. The policy can't hold forever, and when it breaks, it'll send shockwaves through Japan's bond and currency markets. For decades, the yen was seen as a safe haven currency, but increasing numbers of critics are beginning to challenge this myth. Japan's economic problems are no longer short-term fluctuations. They're long-term structural weaknesses. The yen's rapid decline against the dollar shows that its perceived stability is eroding and the safe haven status is falling apart. Now, if you think Japan's central bank is the only problem, think again. The real Achilles heel of Japan's economy is its dependence on foreign energy. Let's take a look at how energy dependency and imported inflation are making things much worse. Japan's reliance on imported energy is a massive vulnerability, and it's playing a significant role in the country's rising inflation. Japan imports nearly 100% of its oil and natural gas, meaning it's highly exposed to global energy price fluctuations. As the yen depreciates, it becomes more expensive for Japan to buy these energy resources, driving inflation higher. This creates a feedback loop where the weakening yen and rising energy prices fuel each other. Japan's lack of domestic energy production means that this isn't a short-term issue. It's a structural weakness in the Japanese economy. The more the yen depreciates, the more expensive its energy imports become, driving up costs across the economy. Add to this the geopolitical risks Japan faces. With its proximity to China and Taiwan and its reliance on Middle Eastern oil, any disruption in trade routes or increased geopolitical tensions could cause severe economic fallout for Japan. Rising energy prices would push inflation even higher, weakening Japan's economic position further. In short, Japan's energy dependence makes it incredibly vulnerable to external shocks, and that's something the Bank of Japan just can't fix with monetary policy. Despite Japan's serious economic challenges, its stock market is ripe with opportunity. The key lies in Japan's export-driven economy. As the yen continues to depreciate, Japanese exporters, companies like Toyota, Honda, and Fanuc, are becoming incredibly competitive on the global stage. Their products are now significantly cheaper for foreign buyers, boosting profit margins and making them standout investment targets. This is where the concept of convexity comes into play. As the yen weakens, the margins of Japanese exporters expand disproportionately. Small changes in the currency result in outsized gains in profitability, which can drive stock prices higher. The document suggests that these companies will continue to benefit as long as the yen remains weak, offering a prime opportunity for investors looking for asymmetric returns. Japanese equities are also undervalued relative to their Western counterparts. Many companies are trading at low price to earnings and price to book ratios, despite holding significant amounts of cash on their balance sheets. This makes them value plays in an era where US and European stocks are largely overpriced. Moreover, Japan is a global leader in robotics and automation, industries that are only going to grow as demand for these technologies increases. With an aging population and rising need for automation solutions worldwide, Japanese companies are well positioned to capture a larger market share in these sectors. Investors who understand this dynamic could reap significant rewards by positioning themselves in Japanese tech and industrial stocks. But with great opportunities come great risks. Japan's bond market, long supported by unsustainable policies, is a time bomb waiting to go off. Let's explore why the bond market could be the next major crisis. Japan's bond market is one of the biggest risk factors in the country's economic future. The Bank of Japan's yield curve control policy has distorted the market by keeping bond yields artificially low for too long. But investors are starting to realize that this can't go on forever. Any attempt by the Bank of Japan to raise interest rates or adjust its policies could trigger a massive sell-off in Japanese government bonds. This would lead to a sharp rise in bond yields, increasing the government's debt servicing costs and potentially sparking a debt crisis. This isn't just a Japanese problem though. If Japan's bond market collapses, it could destabilize global financial markets. But there's a silver lining for equity investors. As the bond market unravels, investors are likely to flee to equities, particularly those undervalued or benefiting from the weak yen. This rotation of capital from bonds to stocks could drive a significant repricing in Japan's equity markets, especially in export-oriented sectors. And if all that wasn't enough, geopolitical risks are adding fuel to the fire. Japan's strategic position in East Asia and its increasing defensive spending make its economy even more vulnerable to external shocks. Let's take a quick look at how these geopolitical factors could shape Japan's economic future. Japan's geopolitical landscape is entering a period of heightened complexity, particularly as tensions escalate in East Asia. With growing concerns about China's assertiveness in the region and the strategic importance of Taiwan, Japan has significantly increased its defense spending. This shift is not just a matter of military posturing, it's a strategic pivot designed to protect Japan's national interests. However, this shift also brings with it economic risks that could compound Japan's already precarious position. The most immediate concern for Japan is the potential for a conflict involving Taiwan. Given Taiwan's proximity and its strategic role in global semiconductor supply chains, any military action there could lead to severe trade disruptions. Japan's economy is deeply integrated with global supply chains, and even a minor disruption in this region could create ripple effects that severely impact Japan's manufacturing and technology sectors. A conflict in Taiwan would almost certainly lead to a sharp rise in global energy prices, a scenario that would be devastating for Japan, which, as we stated earlier, relies almost entirely on imported energy. And we need to touch on this critical vulnerability again. With nearly 100% of Japan's oil and natural gas coming from abroad, particularly from the Middle East, any disruption in trade routes due to geopolitical tensions could have catastrophic consequences. Rising tensions or conflicts could send energy prices soaring, significantly increasing Japan's import costs and pushing inflation even higher. Given that Japan is already grappling with a weakened yen and rising inflation, a further increase in energy costs could severely destabilize its economy. So, where does all of this leave investors? With Japan's currency weakening, the bond market on edge, and geopolitical risks looming, one might think it's a market to avoid. But in fact, there are global investment opportunities tied to Japan's rock and hard place scenario. A great example to wrap this video up with would be the yen carry trade, for instance. In essence, with ultra-low interest rates in Japan, investors can borrow yen at extremely low costs and invest in higher-yielding assets abroad, such as US bonds. This strategy, known as the yen carry trade, increases demand for foreign assets while putting downward pressure on the yen, accelerating its depreciation. As Japan keeps its interest rates near zero, the carry trade could remain a highly profitable strategy for global investors, encouraging more capital to flow out of Japan into higher yielding markets like the US, where returns are more attractive. The more capital flows out, the weaker the yen becomes, creating a self-reinforcing cycle of depreciation. This process not only erodes the yen's value, but also amplifies Japan's economic challenges, while benefiting global investors who can exploit the interest rate differentials between Japan and other economies. Japan's, in our opinion, likely currency crisis, fueled by decades of monetary mismanagement, debt overload, and energy dependency, presents both massive risks and huge opportunities for investors. While the yen's depreciation and the risks in Japan's bond market are real and should not be overlooked, they also create asymmetric opportunities for those willing to navigate this complex landscape. The Japanese equity market, long shunned by global investors, is undervalued and could be primed for a violent repricing. Export-driven sectors, technology, and automation stand to benefit significantly from the weak yen, while strategies such as the yen carry trade offer global investors a way to profit from Japan's low interest rates. In times of crisis, there are always opportunities for those who understand the dynamics at play. Japan may be facing economic challenges, but for those with the right strategy, it could be a market where outsized gains are waiting to be made. Japan, and the tough situation the country currently faces, constitutes one of the many themes or portfolios that we have organized in the Capitalist Exploits Insider Members section. To gain access to the specific companies we're looking at and even more in-depth rationale about our Japan trade and many other sectors, check out the links in the description below. The research used in this video is also available in the description, and we want to thank you so much for watching, and remember to stay informed.